Secured transactions, we're getting to the namesake of this lesson. I know it's almost as if I named the lesson something and it seemed like we were never going to get there, but now here we are. Well, why is that? Everything we've talked about up until this point builds into what we'll see with secured transactions. Now, these are going to refer to transactions in which a borrower, known as the debtor, which now we know a lot about debtors, provides a lender, known as the creditor, with security, also known as collateral, to guarantee repayment of a loan. In a secured transaction, the lender has the right to take possession of the collateral if the debtor fails to repay the loan. This gives the creditor a degree of security in the transaction, hence the name secured transaction. Really, your best example here, car loans and mortgages on houses. If you don't pay the bank back for the mortgage you have on your house, then they can take your house. If you don't pay the auto loan on your car, they'll come and take your car. Really, not that there are examples that aren't as good as those, but those are probably two of the most common ones that you'd be familiar with. Hey, not that any of us are owning houses anytime these days. It's quite expensive. Probably never going to own a house at this rate, but that's just life. Take it day by day. We got examples here. As mentioned, we got auto loans and mortgages. Examples: when a person takes out an auto loan to purchase a car, the lender, also known as the creditor, will typically require the car to be pledged as collateral. This means that if the borrower, known as the debtor, fails to repay the loan, the lender can repossess the car and sell it to recover the amount owed. Now, keep in mind, you can also pledge something else as collateral. Now, theoretically, like in terms of your mortgage, you could pledge your car towards that. It's not as common, but that is something that you can see. Mortgages: when a person takes out a mortgage to purchase a home, the home serves as collateral for the loan. If the borrower fails to repay the loan, the lender can foreclose on the home and sell it to recover the amount owed. Business loans: when a business borrows money to purchase equipment, the equipment may serve as collateral for the loan. If the business fails to repay the loan, the lender can then take possession of the equipment and sell it to recover the amount owed. And then we got pledging stocks. In some cases, a borrower may pledge stocks or other securities as collateral for a loan. If the borrower fails to repay the loan, the lender can sell the stocks in order to recover the amount owed. Now, in all of these examples here, the borrower is providing the lender with collateral to guarantee repayment of the loan. If the debtor fails to repay the loan, the creditor has the right to take possession of the collateral and sell it to recover the amount owed. This will provide a degree of security for the lender and help ensure that borrowers are more likely to repay their loans. All right, let's see an example here: perfecting a security interest by taking possession of the collateral. We're talking about PMSIs, perfecting security interests, a lot of different terms that you are going to be an expert with at the end of all of this. We got a lot of examples, a lot of slides for your best interest. Now, remember, tax always going to be more important on the exam, but if you are looking to earn points with our business law, this is how you'll do it. Now, here we see a secured party can perfect its security interest by taking possession of the collateral, which involves physically holding or controlling the collateral. This method is commonly used for tangible personal property that can be easily transferred or stored. We got some examples of transactions illustrating the perfection of a security interest by taking possession of the collateral. Here we've got a pawnbroker lending money. Well, when a pawnbroker lends money, they take possession of the borrower's personal property as collateral. The borrower can redeem the item by repaying the loan, but until then, the pawnbroker has possession. Now, these examples are different than what we saw because you have possession of the house, technically. You're living in the house with a mortgage situation. The bank, yes, they own it, but you physically possess it. You're the one living in it. You have the keys to it. Now, obviously, they may have a set of keys too, and that's a whole different situation. Well, with a car, you have the car in your possession, right? Even though that's a secure transaction. But this is different where there is security, even though there is not an agreement. There's not a mortgage. There's not an auto loan. This is where this person has possession. Now, we'll see down here, we got these other examples as well, going back to what we saw. Next up, we have a secured party lending money against a valuable piece of art. Now, in this scenario, the lender may take possession of the artwork as collateral until the borrower repays the loan. And then lastly, a lender providing a loan against a rare coin collection. The lender may hold the coin collection as collateral, which perfects the security interest by taking possession. We will dive into so much more about why perfecting a security interest is important. Obviously, having a security interest bumps up your priority in terms of if this person goes bankrupt or getting your money back. So perfecting a security interest or just having a security interest in general, very important as a creditor/lender. Now, in contrast, the following examples do not involve the perfection of a security interest by taking possession because, again, you're not going to, as the auto dealer, you're giving the car to the person. They're driving it around. A consumer borrowing to buy a car. Now, in this case, the secured party typically perfects the security interest by filing a financing statement rather than taking possession of the car. Bank receiving a mortgage on real property. Mortgages on real property are not governed by UCC Article 9, and the lender does not usually take possession of the property. Instead, they perfect their interest by recording the mortgage in the land's records, so with the government. Next up, wholesaler borrowing to purchase inventory. In this situation, the wholesaler usually retains possession of the inventory, as it would be challenging to sell if the secured party had possession. The secured party would typically perfect their interest by filing a financing statement. Talk a lot about that. Filing the statements as well, super important. We will master it. Now we get a nice overview of secured transactions, some things we've seen before, some things we haven't. Building on the things we've seen before, we are becoming experts. Secured transactions involve a debtor providing collateral to a creditor in case the debtor defaults on their debt obligations. This arrangement ensures the creditor has a way to recover their losses if the debtor fails to pay. Now we got some key concepts dealing with attachment, perfection, priority, and a few others here as well. So attachment, we've kind of talked about this, we'll talk about it even more. This refers to the process by which a security interest is created and becomes enforceable against the debtor. The creditor gains the right to take possession of the collateral if the debtor defaults on their debt. However, attachment alone does not provide rights against third parties who may also have an interest in the same collateral. Because we've got situations where it's nice and simple. The only loan this person has is a car loan, and that's it. You're not competing if this person goes bankrupt to get anything else from anyone else. But let's say you've got an individual who takes out a car loan, a home loan, they've got a bunch of loans. Now, you, as the auto dealer, you have to compete against these other third parties trying to collect money. So we see that not only do you want step 1, but you want step 2, step 3, step 4 in order to get higher up on the rankings when it comes to collecting money. Perfection is the process of providing notice to third parties that the creditor has a security interest in the collateral. I kind of think of it like being a lion out on the plains, and you're stepping over the freshly killed deer and saying, "This is mine. All you other lions get away." That's a little gruesome, but that's kind of what's going on here. This can be achieved through methods such as filing a financing statement or taking possession of the collateral. What they say, possession is 9/10 of the law. If you have possession, that is generally a good indicator of who owns it. And then also a financing statement, you're filing with the government saying, I have a right to any proceeds from this or taking this item as collateral. Perfection is essential to establish the creditor's priority over other parties who may claim an interest in the same collateral. So this, again, is kind of competing against the other lines for the freshly killed poor animal. This PMSI, make sure you're familiar with this, a purchase money security interest. This arises when the purchased property is used as collateral for the loan used to acquire it. If perfected correctly, a PMSI has priority over other security interests in the same collateral. We'll see different tiering and systems of which is the most important, which do you want to have. Article 9, we mentioned this on a prior slide not too long ago. This section of the UCC, and we have dived into the UCC a lot, governs most secured transactions involving personal property or fixtures. It does not apply to security interests in land or real property. Not critically important to memorize Article 9 or anything like that, but here we see that we have different types of collateral under Article 9. These are different categories based on their nature and use. These involve goods, so consumer goods such as inventory, equipment. Classification is determined by how the debtor uses the goods rather than their inherent nature. Next up, intangible assets. This includes the right to receive payment for goods or services, accounts receivable, and other contractual rights. Next up, investment property. This category covers stocks, bonds, mutual funds, and other financial instruments. And then proceeds. These refer to whatever is received upon the sale, exchange, or disposition of the collateral, such as when a debtor trades in a car as a part of purchasing a new one. We're powering through. We're having a good time. There's a lot going on here. And the reason I have so many slides in repetition, kind of beating the same drum over and over, I've seen so many people struggle with this. This is a topic that is definitely a little tricky. And we are making sure to drill in each term, how they relate to each other, making sure you understand the order of priority and everything with it. Now, the process of creating a security interest and attachment are closely related, but they are not the same. Creating a security interest is the broader concept that involves establishing a legal claim by a creditor, the secured party, over a debtor's collateral as security for a debt or obligation. However, a security interest is not effective against anyone before it attaches to the collateral. Attachment, on the other hand, this is a specific step Within the process of creating a security interest, it refers to the moment when the security interest becomes enforceable against the debtor. For attachment to occur, three requisites must be met. First, we've got agreement. There must be agreement between the secured party and the debtor, either in the form of an authenticated record or security agreement, or through the secured party taking possession of the collateral. When a creditor takes possession of the collateral, you actually do not need any written security agreement because you have possession. Value, the secured party must also give value to the debtor, usually in the form of a loan or an extension of credit. And rights, the debtor must have rights in the collateral, meaning they have a legal or equitable interest in the property that can be encumbered by the security interest. This, as we've kind of said, you can't give away your neighbor's car as collateral, but also if you have a house and you only have 10% equity in it, you can't pledge, let's say, 50% equity of the house as collateral. Now, a common exam trick is a question which attempts to have you choose that a financing statement must be filed. Filing a financing statement is one of the methods of perfecting a security interest against third parties. Keep that in mind. What is the purpose of filing the statement? Diving in more specifically to attachment, we're going to make sure you are an expert at this. Now, creating a security interest and the process of attachment involve three key requisites to ensure a valid and enforceable claim against the debtor's collateral. First, we've got agreement. Now, I know we're beating a lot of these to death, but now we are seeing these categorized together in terms of how to complete the process of attachment. First, we've got agreement. This is established through an authenticated record of a security agreement or by the secured party taking possession of the collateral. This agreement outlines the terms and conditions under which the secured party has a claim over the collateral. Value, again, we saw this before. The secured party must provide value to the debtor, usually in the form of a loan or an extension of credit. This value represents the consideration for the security interest. And then rights, the debtor must have rights in the collateral. So we're seeing this in specifically now in terms of how do we create a security interest through attachment, because we can create a security interest in other ways. Attachment occurs when all three requirements are met, and this is the earliest date on which the security interest becomes enforceable against the debtor. Now, the debtor can also agree to grant a security interest in future property that they may acquire, thereby allowing the secured party to have a claim on any new assets. When the secured party holds the debtor's property as collateral, they must use care to ensure that the property is not damaged or lost. This duty of care helps protect the value of the collateral and ensures the secured party can enforce their security interest if needed. Right? If we've got this situation where you're taking their prized artwork as collateral and you destroy it by accident or damage it, that's going to kind of put a kink in the whole process here. It's not going to have the same value. It's not going to be able to be used as the same amount of collateral. There's something to consider. Continuing on here, creating a security interest through attachment provides various benefits and serves multiple purposes for both the secured party and the debtor. It benefits both the secured party and the debtor. It reduces the risk for the creditor, enables more affordable and flexible credit terms for the borrower, and ensures priority in bankruptcy proceedings, ultimately providing financial stability and economic growth. Don't we love that? Stimulating the American economy, making sure we're always doing that. Good old law, IRS, FASB, GAAP, whatever it is, any of these institutions, our judicial system, they're here to make sure the business flows. The primary reasons and advantages of this are as follows. Credit extension. Security interests enable creditors to extend credit to borrowers with reduced risk. Right? We talked about credit cards and how you're not really getting anything back if someone doesn't pay the credit card. Yes, you can charge them more interest, but if they just kind of flee and run away, you're going to have to chase them down. It's not like you have collateral over them or rights over any of their property. That's why you charge higher interest rates. By having a collateral as security, the creditor has a way to recover their investment if the debtor defaults on the loan. Lower interest rates, well, when a loan is secured by collateral. Again, talking also about how credit card rates are a lot higher as compared to mortgage rates will be a lot lower. The risk for the lender is reduced, which often results in a lower interest rate for the borrower. This makes borrowing more affordable for the debtor and encourages economic activity. Borrower motivation. A security interest motivates the debtor to repay the loan on time, as they risk losing their collateral in case of default. This incentive helps ensure timely repayment and reduces the likelihood of delinquency. Priority in bankruptcy. In the event of a debtor's bankruptcy, secured creditors have priority over unsecured creditors when it comes to the distribution of the debtor's assets. This priority provides an additional layer of protection for the secured party's investment. Next up, flexibility in credit terms. The existence of a security interest can allow for more flexible credit terms, such as longer repayment periods or larger loan amounts, as the lender's risk is mitigated by the collateral. And then lastly here, improved borrowing capacity. By providing collateral, a debtor may be able to obtain a higher loan amount or qualify for loans that they may not have been eligible for without a security interest. It really is beneficial in theory to all parties. Obviously, we can see exceptions to the case, but overall, we've got these protections, the Fair Debtor Creditor Protection Act, so that whole mess of a thing. We've got rights and protections everywhere, all around, making sure that it is fair as possible.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.